Stop scrolling. This is not another silver hype video. A bullion dealer just said something that should make every stacker sit up straight right now. Not a YouTuber, not a chart trader, a physical silver dealer watching inventory disappear, predicting numbers most people still think are impossible. He didn't whisper it, he didn't hedge it. He said it calmly, like someone who already sees where this market is going. $100 silver, possibly in the first quarter, and something even more shocking by the end of 2026. If you think that sounds insane, understand this first. Silver doesn't move like stocks, it moves like pressure building behind a locked door. For years that door barely moved, silver was stuck, ignored, mocked, left behind while everything else inflated. Then suddenly, the lock snapped, and now the pressure is releasing in violent, unpredictable bursts. $2 up, $3 down, $4 back up, in a single day. This is not normal price behavior. Behind the charts, behind the headlines, something far more important is happening inside physical silver shops. Cases empty, inventory restocked, inventory gone again not weeks later, sometimes within hours. Dealers aren't asking, will silver sell? They're asking, how fast will it disappear this time? And that's why this prediction matters, because it's not coming from theory, it's coming from the front lines. The man making this call has watched silver sit at $14. He watched nobody care. He watched silver grind through the 20s for years, stuck in a channel that crushed patience and conviction. And now he's watching $70 silver hold as a floor, not a ceiling. That alone should tell you something fundamental has changed in this market. But the real signal isn't the price on your screen, it's the behavior of buyers and sellers. When prices spike, people sell. When prices dip, smart stackers step in quietly and absorb supply. This is not fear buying anymore. This is strategic accumulation during volatility. And volatility is increasing because the old control mechanisms are losing effectiveness. Margin hikes, futures pressure, paper selling, none of it is stopping the physical flow. Silver moves when confidence in paper claims breaks, and that process has already started. That's why a 30% move to $100 isn't extreme in this environment. It's actually small compared to what silver did last year when it shocked nearly everyone. A 148% annual gain doesn't happen in a healthy, balanced market. It happens in a market repricing itself after years of distortion. And repricing doesn't stop politely at round numbers that make people comfortable. It overshoots, it tests disbelief, it punishes hesitation. So the real question is whether silver can hit $100. It's whether most people will be positioned before it does. When silver crossed $70, most people assumed it was temporary, just another spike that would fade back into the old, familiar range. But days passed, then weeks, and something strange happened. Silver didn't collapse, it stabilized. 70 stopped acting like resistance. Instead, 70 began behaving like a floor, defended quietly by real buying pressure underneath every dip. That's the moment experienced dealers start paying attention, because floors form when supply tightens, not when speculation runs wild. Inside the shop, the story looked very different from what paper charts suggested on the screen. Every restock triggered immediate interest. Coins didn't sit, bars didn't linger, inventory flowed straight from shipment to customer hands. Even when prices jumped $2 or $3 in a day, silver didn't scare buyers away. Instead, higher prices triggered selling from some, but equally aggressive buying from others watching for any brief pullback. This back and forth wasn't chaos. It was price discovery, happening in real time with physical metal as the anchor. Dealers noticed something else too. Premiums began disappearing, even as spot prices stayed historically elevated. That doesn't happen when supply is abundant. It happens when turnover becomes more important than markup. A Libertad selling for the same price as any government ounce would have sounded ridiculous just a year earlier. Now it barely raises an eyebrow, because availability matters more than branding in a tightening market. This is where the prediction starts making sense. When physical flow accelerates, paper price eventually follows. A 30% move from $70 to $100 sounds dramatic, but mathematically, it's modest by silver standards. Last year alone, silver climbed nearly 150%, shattering every conservative forecast along the way. Compared to that, a move to $100 is not a leap, it's a continuation. And this time, the move wouldn't be driven by hype, it would be driven by necessity. Because at higher prices, sellers hesitate, while buyers increasingly view dips as rare opportunities, not warnings. This behavior shift is subtle, but it's critical. It marks the transition from speculative trading to strategic positioning. Dealers feel this shift before analysts ever acknowledge it on financial television. They hear it in conversations. Customers aren't asking, "Should I buy silver?" anymore. They're asking, "How much can I get today before it's gone again?" That's why a $100 print in the first quarter doesn't shock professionals watching the flow daily. It shocks only those still anchored to outdated price ranges from a different monetary era. The reality is, silver is no longer trading in yesterday's system. It's reacting to inflation, geopolitical stress, supply constraints, and a loss of confidence in paper promises. Those forces don't unwind smoothly. They unwind in bursts, overshoots, and sudden repricings. And once silver breaks into triple digits, the psychological dam weakens even further. Because after 100, the question shifts from "can it" to "how far does this really go?" To understand why $100 silver is plausible, you have to stop thinking locally and start thinking globally. Because the pressure on silver isn't coming from one country, one exchange, or one group of investors. It's coming from the structure of the supply chain itself, and that structure is quietly tightening. One of the most underreported developments is China's increasing control over refined silver production and exports. Estimates suggest China influences 60 to 70% of the world's refined silver flow. When a country with that level of control restricts exports, the impact isn't immediate shortages. The impact is uncertainty, hesitation, and a growing premium on guaranteed delivery. Silver is still available, but only if buyers are willing to pay increasingly uncomfortable prices. That distinction matters. Because markets don't break when supply disappears. They break when price sensitivity disappears. Dealers aren't saying, "We can't get silver." They're saying, "We can get it, but it's getting expensive fast." And when buyers accept that reality, price becomes elastic in a way models fail to capture. This is where paper markets struggle, because futures contracts assume predictable, liquid physical supply. Recently, the COMEX responded with one of its largest margin hikes in decades. A 30% increase in silver futures margins wasn't a routine adjustment. It was a pressure release valve. Margin hikes are designed to cool speculation, but they also reveal stress beneath the surface. Despite those measures, silver didn't collapse. It absorbed the shock and stabilized. That's a warning sign for anyone assuming paper tools still fully control this market. When margin hikes stop working, it means physical demand is overpowering financial restraint. At the same time, price discrepancies are widening between regions. Silver trades at noticeably higher levels in Asia than it does in Western paper markets. Those spreads don't persist forever. They close through price convergence, not polite negotiation. And convergence almost always means higher prices where supply is constrained. This is how localized controls turn into global repricing events. Meanwhile, mining supply can't respond quickly enough to relieve the pressure. The world has been running a multi-year silver deficit, estimated at 6 to 7 years of underproduction. Even at today's prices, bringing new silver online is slow, expensive, and operationally complex. Most silver isn't mined directly. It's a byproduct of copper, gold, and base metal mining. That means silver supply doesn't surge just because silver prices rise. It responds on a delay measured in years, not months. And that delay is exactly why predictions like $150 silver no longer sound absurd. While silver commands attention, something equally revealing is happening on the other side of the metal's counter. Gold cases are sitting empty, even with prices pushing $4,300 before premiums. Fully delivered gold eagles and buffalo are selling north of $4,500 an ounce. And yet, when dealers manage to acquire a few pieces, they disappear within hours. This isn't panic. It's conversion, consolidation, and portability driving demand. Older stackers are trading bulky silver positions for smaller, denser gold holdings. Not because they distrust silver, but because they want easier transport and storage. But here's the critical insight dealers are sharing quietly. Many believe it's still too early to trade large amounts of silver for gold, because the gold-to-silver ratio hasn't finished adjusting to the new price regime. Historically, during precious metals bull markets, silver outperforms gold late in the cycle. That's when ratios compress aggressively, rewarding those who hold silver longest. If silver pushes toward 100 or beyond, that compression accelerates. Trading silver too early risks surrendering future purchasing power. Dealers aren't discouraging trades, they're encouraging patience and selective conversion. A coin here, an ounce there, strategic, not wholesale liquidation. Because once silver breaks triple digits, gold availability could tighten even further. Some have long feared that when the trade window opens, there won't be enough gold available. Dealers confirm gold can be ordered, but delivery delays are increasing under demand pressure. What used to take days can now take weeks during periods of heavy trading. This lag matters because markets don't wait politely for inventory to arrive. They reprice based on expectations, not assurances. And expectations for 2026 are shifting faster than most people realize. Once investors believe $100 silver is real, behavior changes permanently. Hesitation turns into urgency, dip buying turns into front-running. At that point, silver is no longer chasing gold. It's pulling gold higher by force of ratio compression. This dynamic is why experienced dealers hesitate to call tops. They've seen how quickly silver can move once psychology flips. And 2026 looks increasingly like the year that flip completes. Another force quietly re-entering the silver market is capital that previously abandoned precious metals altogether. For years, money flowed out of metals and into cryptocurrencies, chasing speed, leverage, and exponential narratives. That rotation hurt silver, not because the fundamentals weakened, but because attention shifted elsewhere. In 2025, that dynamic reversed in a way few expected. While silver surged more than 150%, major crypto assets quietly underperformed or declined. Performance speaks louder than ideology when capital decides where to go next. Some investors who chased digital volatility are now rediscovering physical scarcity. Silver offers something crypto cannot: no counterparty risk and no dependence on network trust. As even a small fraction of that capital returns, silver's relatively tiny market amplifies the impact. It doesn't take trillions to move silver. It takes marginal demand overwhelming fragile supply. This is why black swan events matter so much in silver's price trajectory. Geopolitical shocks, currency instability, or financial accidents don't need to be predictable to be influential. They only need to happen once, at the wrong time in a tight market. That's when 100 becomes a waypoint, not a destination. Still, experienced voices avoid certainty, even when conviction is strong. A return to $40 or $50 would shock sentiment, but it wouldn't invalidate the long-term thesis. It would represent opportunity, not failure, for those who understand cycles. But if momentum continues, $150 over the course of 2026 enters the realm of realism. Not because of hype, but because of structure, flow, and delayed supply response. Markets don't move to where people are comfortable. They move to where balance is forced. And silver's balance point has been distorted for more than a decade. Reversion doesn't arrive gently. It arrives decisively, sometimes violently. That's why dealers emphasize preparation over prediction. Those positioned early don't need perfect timing. They only need patience, while others scramble for exposure. As 2026 unfolds, Silver will continue testing conviction on both sides of the trade. Some will chase, some will doubt, some will wait too long. But the physical market will keep sending signals long before headlines catch up. Inventory flow, delivery delays, and buyer behavior will tell the real story. And when the dust settles, silver won't ask who believed. It will simply reveal who was prepared. Before you close this video, understand this isn't a call to panic or chase prices blindly. It's a reminder that silver rarely gives clear invitations before it moves decisively. Most people don't miss silver because they disagree with the thesis. They miss it because they wait for certainty in a market that never provides it. By the time headlines confirm $100 silver, positioning will already be crowded. Dealers won't be asking what silver should cost anymore. They'll be asking how much inventory they can realistically secure. That shift happens quietly, then all at once. If silver reaches 100, psychology won't reset lower. It will recalibrate upward, changing how every dip and rally is interpreted. From that point forward, 150 stops sounding extreme and starts sounding conditional. Conditional on supply, confidence, and how much physical metal actually changes hands. That's why the smartest participants aren't predicting exact numbers. They're measuring flow, watching inventory, and managing exposure deliberately. Silver doesn't reward emotion. It rewards patience during boredom and discipline during volatility. As 2026 unfolds, the market will test both relentlessly. Some viewers will watch this and do nothing. Others will quietly position and never talk about it publicly. So here's the real question worth answering honestly. When silver rewrites expectations again, will you be reacting or already prepared?